Good morning. Welcome to Stock Market Today. It's Friday, May 8th, Jobs Day 2020. I am Dan Russo, Chief Market Strategist at Cyclical Analytics. Thanks for taking time out to be with us here this morning. As always, you can follow me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Cyclical Analytics. Head over to cyclicalanalytics.com/today where you can sign up for a free email where I get a lot of the content for this show, as well as give you daily stock ideas to consider. Hits your inbox every trading day before the market opens. So U.S. equities finished higher in Thursday's trading, though ended near the lows of the day for the third consecutive day. Energy and financials led while staples and healthcare closed in the red. Treasuries were stronger with the curve flattening and the two-year yield hitting a new record low. The dollar was mixed on the major crosses. Gold finished up 2.2%. WTI crude settled down about 1.8%. As we get to the desk this morning, futures are up 1%. Ahead of the April jobs report. Asian markets were higher overnight, with Japan up over 2.5%. European markets are gaining as well. Treasuries are mostly weaker with the curve flattening. The dollar is stronger against the yen, weaker against the euro. Gold up 0.5%. WTI crude up about 3.5%. As we look at the structure of the S&P 500 here, we're still in the zone ahead of that April jobs report, which is due out at 8:30. Kind of just consolidating that 3-week grind. What's interesting to me is that, again, as I said, for the third day in a row, markets tried to pop and then close near the lows of the day. So just something to keep in mind, and that has actually caused Chaikin money flow to dip negative here in the near term. Dip below zero, dip bearish, call it what you want. We're not overbought, we're not oversold at this stage of the game based on the 13-period CCI. Resistance on the upside, 29.50 to 30.05, the 200-day moving average at 30.02. Support 2750 to 2800, below that 2485 to 2660 begins to mark out the key retracement levels of the advance from the March 23rd low. So everybody knows that the jobs number is going to be bad. Estimates are at about negative 21 million for the month of April, likely the worst that we've seen in our economic history or close to it. The question is, what are expectations? Again, we all know it's going to be bad, and where does the number come in relative to expectations? And that all plays out as the market is kind of stuck between support and resistance, kind of in this area, in my mind, that I just call frustrating. No clear trend here over the past 3 weeks of trading. Taking a look now at our market in a minute. What are we writing about in the note today? Well, we closed higher ahead of the jobless report, although we did close near the lows of the day. Small caps are testing near-term relative breakout levels, while small cap growth begins to show leadership. Cyclical sectors, in my opinion, better depict the economic damage. There's a lot of talk about how the market, the quote-unquote market, is disconnected from economic reality, and if all you're looking at is the SPY or the Qs, that might be the case. But if you drill down under the surface and look at the cyclical sectors, which we're going to do later in the show, you'll see what I think better depicts what's going on the economic front. And as I said, futures do point to a higher open here this morning. Taking a look at the major indices now from a power bar perspective, the Dow adds 86 basis points, 2 to 15 bulls to bears there. S&P 500 up 1.17%, still bearish though on the ratio, 52 to 163. NASDAQ is bullish on the ratio, 25 to 19 is attacked on 1.28%. Small caps, small outperformer, 291 to 377 bulls to bears there. Bonds uptick, sending yields lower. Energy was your leading sector, up 2.6%, but still no bullish stocks and 20 bearish stocks within the energy complex if you're drilling down on the individual components of XLE. According to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks. Major markets are mixed. Taking a look at our stock of the day now, and this is kind of a bit of a play on the theme that I'm writing about in my note today, which is improving relative strength in small caps being led by small cap growth. So I drilled down on the small cap growth ETF, IWO, and found a name that looks compelling to me, Merit Medical Systems. Very bullish rating here at Chaikin Analytics based on our 20-factor model. Strong trend, strong industry group. The stock is oversold, and money flow has been mostly bullish of late, above the rising long-term trend line. So very bullish stock outperforming the market becomes oversold with bullish money flow. That looks like a compelling setup to me at the stock level, especially if we look at it in light of the fact that it's within a strong sector of the market, healthcare. It's in an area of the market that's beginning to lead small cap growth. So just kind of putting all that together, and this looks like a compelling opportunity. I'm highlighting it in my note today for clients, and I'm highlighting it here for you on the show. A few ways to play it. Obviously, I think the setup looks good here now, but obviously we're still in a volatile environment. So maybe you could take a look at it and buy the breakout through the $45 level or so, if that makes sense for you, if you're a breakout trader. No one says you have to take a full position if that's how you choose to do it. There's plenty of ways to look at how to put the trade on. I just think it looks like a compelling opportunity. And if it fits within your framework and your process, I think it's worth paying attention to. Turning now to the sector tracker, the movement of the major sectors over the last 5 days of trading, and it paints a pretty picture of what is largely the big picture trends are, in my opinion. Tech, comms, and healthcare at the top of the list. Tech, obviously, growth, leadership, doing well there. Comms carry a lot of the fan mag names that we talk about, and that has done well of late. Those two groups are the only two groups higher over the past 5 days. Healthcare down, but leadership over the last week of trading. Materials, discretionary energy, and staples are middle of the road. Energy, utes, industrials, and fins at the bottom of the list. We talked a lot about the financials this week. Industrials, obviously one of those more economically sensitive cyclical plays. Same with energy. And we'll take a look at a graph a little bit later on in the show that kind of paints that picture that I'm talking about, paints the picture that if you look beyond the index, if you look beyond the headline S&P 500, you see a better picture of what is economic reality. When you look at areas like energy, when you look at areas like industrials and financials, these cyclical groups that have massively underperformed over the past 3 months. Now, it's almost 3 months ago that the market topped out. Market top was February 19th. So just kind of looking at it in that perspective allows you to kind of take a step back and say, yeah, you know, the S&P appears to be somewhat disconnected from the market. The market is not the economy, but at the same time, the market is much more than 6 mega cap growth stocks. Taking a look at our industry in focus, though, speaking of growth and innovation in tech, is Innovative Tech Services, which has been outperforming over the past 6 months, up by about 15%. Power bar ratio is strong with 15 bulls to 10 bears. Currently ranked number 7 of 21 subsectors, moving up 4 slots over the past week. So some of the names there that might be worth doing some work on: 2U, TWOU, very bullish. SINA, SINA, very bullish. And SS&C. SS&C Technologies, ticker symbol SSNC, also with a very bullish rating. If we take a look at the fund, the XITK is the fund that tracks this group. 15 to 10 bull bear ratio, strong trend above a rising long-term trend line here. Notice the overbought, oversold indicator is moving higher after failing to reach an oversold position. To me, that's a sign of bullish momentum as money flow is strongly outperforming here in the near term, right? So this kind of does paint the picture of what leadership looks like within the marketplace. If I'm looking for ideas, you know, I probably want to take something like XITK, drill down on its holdings, look for those bullish and very bullish stocks, and begin to do work and figure out which of those stocks are setting up, you know, for your time frame, for your risk tolerance, and for the style of investor that you are. Moving on to what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. The gainer side of the board is all earnings related for the most part. Fortinet making commentary that they are seeing a tailwind from the work from home trends as they reported earnings yesterday. FTNT up 21.23%. LNC reports earnings 16.25 to the good. PayPal, their earnings missed, but their guidance was better. PayPal is a bullish stock, up 14% yesterday. Ameriprise Financial, their earnings report sent the stock higher in conjunction with them saying that they were going to resume their buyback, which they halted in March, kind of talking up their solid cash position and balance sheet, 13.5% to the good. And IRM, a neutral stock, up 12% on the heels of their earnings announcement yesterday. Loser side of the board, top 2 names, no real company specific news that I could see. WELL down 7.3% on the day. LW, Lamb Weston down, WELL was down 7%. LW down 5.7%. HFC, Holly Frontier, reported earnings yesterday. Investors take 5.66% out of their stock. VTR, nothing really company specific yesterday. I do know that they did report earnings here this morning. That stock down 4.75% on the day yesterday. And CTL, CenturyLink, down 3.64%. Earnings report yesterday, see that their price target was lowered at one of the banks. So pressure on that stock throughout the day yesterday. Let's dive in now. Because this is intriguing to me. We're seeing a relative improvement in small caps. Now, we have been small cap haters for a long time, largely a function of this top chart here, which is the IWM relative to the SPY, right? So how is IWM performing relative to the broader market, right? And clearly, leadership in the market has been large cap and growth, right? So small caps have been underperforming. You can see the clear trend on the ratio chart here below the declining 200-day moving average. But with the market bottom in March, this trend began to stabilize a bit, right? Kind of carved out this range that we've subsequently broken topside, and now we're pulling back to retest. Now, as this range played out, the RSI made a series of higher lows, which I was documenting in my note every Friday, as it now tries to shift to bullish ranges, right? It's early days still, but this is just something, a subtle shift under the surface of the market that's caught my attention. Should small caps continue to move higher on a relative basis, and should small caps RSI of this ratio hold in bullish ranges, to me, that would be an indication that we're seeing some broadening out of participation to the upside in the rally. Take a look at the bottom of the chart, the IWM on an absolute basis. You can see the collapse right into the lows, and now the rally back. We've actually broken back above the late 2018 lows, and so far holding that. So I think that this is an important chart to be paying attention to, both on a relative and absolute basis, because it points to the potential for broadening out. Now, we've talked about breadth, how breadth has been sluggish. Go back to the show yesterday, how breadth has been sluggish to improve since becoming extremely washed out in the downturn. If we could start to see small caps doing well, that would go a long way towards improving that breadth picture and start to paint a better picture for the recovery in the market. So this is an area I think that needs a lot of focus. I think we want to be paying attention to small caps on both an absolute and a relative basis, if for nothing else, but for the breadth picture that it could potentially paint. And now, as I drilled under the surface, I wanted to take a look and say, all right, if the relative performance of small caps is improving, where within small caps is that playing out? And it's small cap growth, right? So growth still the theme. But take a look at the IWO, the iShares Russell 2000 Growth ETF. Big rally off the lows with the market, trying to get back here. Former support now acting as resistance below the 200-day moving average. But check out the RSI, right? Similar divergence in play, trying to hold within bullish ranges here in the near term, right? If you take a look at small cap value, it's a different picture. It still doesn't look good to us. It's a bearish ETF rating, the IJS bearish ETF rating at Cheek and Analytics. Now, IWO is neutral, but it's the relative that's really caught my attention here once again, in conjunction with this RSI improving. Take a look at the bottom of the chart here. IWO relative to the SPY, you can see the drop into March, right? And then this consolidation that has broken topside, been retested, and is starting to work higher once again. So drilling down, if I'm starting to try to paint the picture of what, a recovery in small caps could look like, I think it's being led by small cap growth, right? So I drill down on small cap growth and identify a name like MMSI that we talked about earlier in the show. That's kind of gives you a little bit of an inside baseball on how I look at the markets and how I look at the world and how I kind of come up with, what I think are compelling ideas. Now, I'll wrap it up with this. Cyclical sectors paint the economic picture in my view, right? Again, a lot of talk about how the market seems to be disconnected from the economy. But if you look over the past 3 months of trading at the relative performance of the sectors, take a look at the big bars that shoot down from the center line, right? Industrials, energy, financials, those are your cyclical groups. And this is their underperformance relative to the S&P 500. So yes, while tech and healthcare and to some degree discretionary, thanks to Amazon, have dragged the market higher, drilling down under the surface, you might want to rethink the market is disconnected from economic reality argument. It's just playing out at the sector level as opposed to the headline index level. So those are just my thoughts today. Hope everybody has a great weekend. Head over to cheekandanalytics.com/test drive to sign up for a free 14-day trial. Stay well, be safe, enjoy the weekend. I'll be back on Monday.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.